Good morning, everybody. It is Wednesday, June 11th, and we are going to start our prep for CPI. First, we'll start with a review of yesterday. We posted our trades in our professional room at 8:56 yesterday morning, and we were looking for a long at 6,003. We stopped about three ticks shy of our level, but that would have been your entry signal. And then we had targets at 21 and 42. So that was the easiest 20 to 40 point trade yesterday on the S&P or the ES futures. On the NASDAQ, we listed out our best trades and we had a long at 773 plan with targets at 858 and 916. So again, an easy 150 point trade. And then again, 858 was our next long with watch area of 916 and target at 22,005. So by the end of the day, you would have been pretty close to your target again for at least 50 to 70 points, if not more than 100. So again, on two micros, if you are in an eval or a combine and you are struggling to pass, these are your easiest $400 to $800 trades on a couple of micros, so you're not over risking and not blowing your accounts. If you have bigger size and you can trade minis, this is the easiest way to make $5,000 to $10,000 a day. We've done this now consistently each day, giving you these trades, and hopefully you guys are beginning to capitalize on these as our students do. Now, we will start our prep for today, and as always, remember that derivatives trading is inherently risky and past performance is not indicative of future returns. So we'll skip over some of our normal viewpoints as nothing has changed in terms of our COT report, and high yield is still the same, as well as corporate bonds. We're not getting any major signals here. The business cycle we went through this yesterday is signaling more complacency and upside. We will watch this at 118 for any signals to change to tell us any potential downside. But with business cycles closing next week and at the end of the month, that is more what's going to matter. As quarter end, again, business cycles matter. We need to think of the market as a business. Even though there's ongoing auctions every day and there are short-term participants, what really is driving this is the systematic flows, the expected flows, the business side that requires certain trades to be carried out. That is what we can use to really build a strong edge and understanding what is happening under the surface. Into bonds, again, move index is still signaling near max complacency. So similar here, waiting for the next business cycles to shift, ending, which will shift the positioning some, and we can watch for the ball underwater scenario to play out. Now, on multi-asset volatility, we have given out these levels in our written prep. We did them one day on our morning session, but in our written prep that we post for our daily, professional subscribers, they've had these levels of 16, 37, 18, and 20, and the 18 is going to signal more upside charm. So that is the area to watch if the market gets to that we are nearing a bottom. So yesterday, when we are looking for that long, uh, either at our 6,003 or at the 21, we did have a long planned at 21 with targets of 42 and then up to 80, which we didn't quite get to. But even getting long here, you would have never been stopped out. We can use our volatility signal. So 18 was the big signal. We got right up to 18 to the tick and then had a strong sell-off. Is that a surprise? No. Did it matter what the catalyst was and something that was said either by the current administration or the China talks? It doesn't matter. This is all a function of positioning. Somebody else far deeper into the inner workings of the markets will know these things ahead of time. There are people in the administration, there are links, there's insider trading, there's always factors going on. It's, we don't get access to that, but we don't need to. We can use the signals and the process to understand where things will change and why they will change. So again, getting up to 18 signals likely bottom in the market. until we confirm over that. So any chance we get to 18, we're looking more for buy signals. Down at 1637 is our next one. We will be looking for market topping signals. If we get over 18, then that changes and our key levels are posted for our professional subscribers there. On to the insurance for today. Still complacency. So traders did buy insurance for CPI today, but not much. We're right inside our yellow bands. Normally we end up inside of our red, and our red is when we get into the red zone, we are looking for a strong upside move. Again, we think of that as we're about ready to really score, to get a touchdown, to have a big move for the longs, but we're not getting that today. So what does this tell us is that our washing machine isn't going to be fully turned on for cycle today. We are not looking for an exaggerated move on CPI today, at least not to the upside. If we do go upside, it's more likely going to be mean reverting. So we are more likely to come back down as we don't have everybody crowded into one side of the boat that's going to force that big move up. That is the easiest trade to see when we get that. But without that, this opens the door for potential downside, or most likely scenario is going to be mean reversion and more nothingness than anything. There is some protection, so it will limit the downside, but this is saying that there is complacency and more likely sideways, more muted response. We saw this last week as well as we headed into some of the jobs reports. Similar setup. Some of them were overinsured and we saw the bigger moves. Some of them were moderately protected and we just saw nothingness. So the key today is going to be our minor line in the sand, which we'll get to that when we get to our levels. We also look at the cost of doing business. We don't show this daily. Our students have access to it real time, but we always want to follow when the costs change so we can understand the underlying business dynamics. When the cost of business rises, think of it like cost of goods sold or labor cost for a small business. If you've ever owned a small business, you know that when your COGS rise or your labor rises, everything else, your rent and others are pretty much fixed cost. Electricity changes a little bit, but for the most part, it's your COGS and your labor are what are going to drive your profitability. So when we see the cost rising, that's these blue bars, that brings potential downside into the market. Now, we also look at this over duration, and when we're under zero, that becomes more supportive because these costs were much more. So we had cost rising substantially, which led to the April decline, and this was our early canary in the coal mine back in February that costs and the business model was changing. Then in April, there's still potential for some downside as we have costs rising, but overall, these costs are getting cheaper, so that signals potential upside. Now, once the cost of business really breaks, it stays under what it has been. So costs are getting cheaper. It's getting cheaper to buy your supplies, or you're able to operate with one less employee. You increase your profitability. So that is the market is more favored for the upside. Then we see when these costs rise, the market dropped at the end of May. And then as these costs begin to cheapen again, and you can see on duration, we are coming down, it is more likely for that upside move. So we're always monitoring this as the cost of business. Again, in the markets, this is a business. For most traders on the retail side, this is more fun, or it can be treated as gambling. But if you actually are serious about this and want this to be your profession, you need to think of it like a business and understand what the large firms are doing and how they have to position and how they have to handle their books. You know, whether it's a long only pod shop, a neutral pod shop, a long short book. This is what we're looking for, is what is their cost of business and how does that affect the underlying dynamics in the market. So right now, what is this signaling? Costs are cheaper. We always monitor this again for any changes so that we can be on the front end of that. But right now, again, more upside favored. So we're getting complacency across the board as we're coming into the ending of a couple business cycles. All of that is saying No major downside at this moment. Even with the insurance today, if we do go down on CPI, we have some levels below us that we'll keep an eye on that again will signal more support coming. So if we look at lastly, before we get into our levels today, we'll show positioning. And we actually can see the dollar amounts here. This one is about $3.88 billion on June 20th. So on next week, ahead, just after FOMC and Juneteenth, and on OPEX, right at 6,000, we're going to have a $3.88 billion position. For today, 6056 is your key area for more upside, and you can see this. If we look at this as a heat map, you can see the sizing of the positioning, the dollar amounts that are already sitting on the books on different durations. We also can scale this up and down and see that at 5,900, we can see the exact dollar amount that is sitting there as well. That is giving us, again, another advantage in the market to see this positioning. So just to give you guys an idea, at 5,900 for month end on June 30th, there is a $1.41 billion position that will act as a bid on by June 30th. If we get down there, we could stay over that, and that position is going to be very profitable. But as we get closer to that, on month end, that is going to be a key area to watch. And we can see this all the way down as far as we want, down to the 57s, or as high as we need to into the 62s, 62, 63. There are people that have positioning that far out. Again, this is why we think of the market as a business, because while we are day traders ourselves and we are trading the movements and the oscillations in the market on a short term, we want to know where the big money is sitting and how they are positioned. And then we go in depth with our students on how to use all of this information, as well as real-time access to all of these tools. So with that, we will get into our levels for today. And again, if you are a professional subscriber, all of my levels are listed below here. We do have rotational price action expectations between 6,007 and 6053, with our pivot at 6029 3/4. If we get over 6053, our upside targets are 6076 quarter and 6090, and our lower targets, if we break 6,007, are 59, 69 3/4, and 5980. Our major line in the sand is at 59.19. So again, the business model changes if we break that. Otherwise, the business model overall will stay the same. And our minor line in the sand is at 6,003 3/4, just under our rotational low. So if we break that rotational low and we get under our minor line in the sand, some business models begin to change, and we can begin to look for a little more downside to 59.90 and 59.74. Some other key levels for you today are going to be 60.56 half, 60.20 3/4, 6,000 3/4. So again, right at our minor line in the sand, we know where there is a large position. 59.85 quarter and 59.59 3/4 are going to be your levels on the ES. Now on to the NASDAQ. We are looking for rotational price action from 21,795 half to 22,003, with our middle of that, our pivot at 21,900. So we just came down to that actually at 8 o'clock here. We came down to 21,890 half and then went right up to 990. So that was that's how we'd look at our pivot, is we'd go from one end to the next, and we are holding that for now. So if that changes, then we'll look, if we break below that, then we'll look for that 21,795 half. Our upside targets today, if we break out of our rotational zone, are going to be 22,108 half and 22,173 quarters. And our lower targets are going to be 21,629 to 21,692. Our line in the sand is far below us at 21,377. So we have quite a ways to go before that changes the business model. So even if the ES were to change, we also want to pay attention to the NASDAQ because they have similar components. And we look for similar sets inside of the market. Key levels for you on the NQ today: 21,916, 21,858, 21,773, and 21,613 half are going to be the other key levels to be watching. On to gold. So gold here, we are looking for rotational price action today. If we stay between 3328.1 and 3372.7 with our pivot at 3350.6. Our upside targets are 3395.2 and 3408.6. And if we break 3328, we'll look for 3292.7 and 3306. On oil, so yesterday we did hit our upper target that we gave you at 66.25 from the morning plan and the levels, and then we've re-entered the rotational zone. And so we see that here, that we were looking for a long up to 66.25 over our pivot, over our rotational high at 65.50, and we made our move up. So we got over our 65.68 and made our move up to our first upper target. And then we came back inside our rotational zone and came right down to the lower end of that rotational zone at 64.53, missing the low by 3 ticks. So again, we always want to pay attention to what this is, because once we get in the rotational zone, we look for a move back through, and we use that pivot as the key area in the middle. So this was another easy $100 to $200 trade, depending on if you're doing micros or if you're doing minis, a couple $1,000. Just based on the expected moves and based on multiple factors that are all calculated into these instruments based on for their levels based on the underlying dynamics of each instrument. So today for oil, we are looking for rotational price action 64.63 to 66.15. Again, these change every day. The pivot is 65.39. Our upper targets are 66.92 and 67.37. And our lower targets are 63.41 and 63.86. Now, we do get crude inventories today, so pay attention to that at 10:30, as that is typically a market mover. Your other key levels above us are going to be 67.73, 67.27, and then 66.40, and below us 65.42 and 63.89. So with that, guys, as always, control your risk. Make sure you are paying attention to how much you're risking so that you can survive in this long enough. You can make a lot trading smaller size because you can be consistent over time, and a few paper cuts aren't going to hurt you. But if you oversize your account and you lose everything on 1 or 2 trades, you are doing no different than going into the casino and putting it all on black and it lands on red and you are wiped out. Your job is to stay in this if you are treating this as something you want to do full time. So remember that. And with that, guys, I will post my trades around 9 to 9:15 in our professional room. I will wait for CPI to come out. And again, this will be available. The full write-up will be available in our professional room. So have a great day, everybody, and we will be back again tomorrow.